Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now last week's been all about US job market data. Now one aspect that jumped out of course was a weakness in first half data after you incorporate the revisions downwards to the previous set of data. But of course what was a bit of a shocker of course was not only the data itself and the extent of softness but the subsequent firing of the labor statistics head herself. Now will this lead us to a bad news is good news situation via Fed cut, or a bad news is bad news situation given some stretched positioning across a few key risky assets? To discuss this and more, I'm joined today by Heung, who's a senior investment strategist at the CIO office. So welcome, Ray. Thanks for joining us today. So in your view, weak US job market data, does that cement a Fed rate cut in September?
Yeah, thanks, Manpreet, for having me. Yes, I think September rate cut has been our expectation for a while, and I guess one of the main driver for our view is actually a slower U.S. job market, and we do believe that the July job report has given us such an affirmation. And in fact, if you look at the data, the U.S. job market has been slowing in recent months. For example, when we look at net new payroll. Increase for July was 73,000, which is much weaker than expected. And more importantly, I think there is a significant downward revision to prior 2 months payroll by a pretty massive 258,000. So that means that the U.S. net job creation has been averaging only 35K per month in the past 3 months, and that's compared with the prior estimate of 150K. So the revised monthly rate of job creation is now well below the rate required to keep the unemployment rate stable. And we believe that a sharp slowdown in supply of workers due to immigration curve is probably partly responsible for the slowdown in job growth this year. But increasingly, this is replaced by a slower pace of hiring. And according to data from the Yale Budget Lab, the higher U.S. tariff that took effect from the 7th of August will cut the U.S. growth by 0.5% in 2025 and 2026. And to us, this is likely to impact domestic consumption and corporate margins and depressing hiring further. So with the job market slowing decisively, we think the Fed shall resume the rate cuts from September. Now, Fed Chair Powell actually sounded relatively hawkish after the last policy meeting. And that is when the Fed held rates unchanged for the fifth straight time, and with a cautious stance against expected tariff-driven inflation. However, since then, at the least, 3 Fed policymakers have voiced increasing concerns about the deteriorating job market after the July job report, and this adds to the 2 Fed policymakers who has unsuccessfully voted for rate cuts in the last month. And this is the first double dissent in over 3 decades. So one more thing to note, the next rate decision is in September. And before that, the July and August inflation report and also the August job report will be closely watched. And the market's odd for a 50 basis point cut will increase if these reports comes in below expectations.
Thanks for that context. In your view, what does this mean for risky assets? Is bad news likely to be good news?
Yeah, I think we think the negative factors to risk assets obviously is being the weaker economic growth, as U.S. job creation slowed down, and also higher tariff comes into effect. We think the U.S. stock, especially the technology and communication service sector, are facing near-term headwinds because of excessive bullish investor positioning. Now, however, we see the rate cuts and combined with individual corporate tax incentive in the next fiscal year's U.S. budget, and also as the strong AI-driven corporate earnings growth should support the U.S. risk asset. However, we think 3 factors should lend support to the risk asset in the U.S. Number 1 is obviously the Fed rate cuts. Number 2 is the upward revision of the outlook of corporate earnings, driven by the AI-led growth. And number 3 is the individual and corporate tax incentive in the next fiscal year after the passage of the, one big and beautiful bill. So given these positive drivers, we would average into the US equity on any pullbacks in the S&P 500 index towards 6,000 and followed by 5,800 level. Outside of the US, we also prefer Asia and Japan equity, emerging market local currency bonds. And we also see that as Fed rate cuts and weaken the US dollar, this will drive investor flow into the EM markets. In Asia and Japan equities, we particularly like South Korea and China, where the policymakers are focused on boosting shareholders' returns.
Okay, well, staying with that last point on Asia and emerging markets for a moment, what's your view specifically on Korean equities, as you discussed, but also on Indian equities, following what's been going on with U.S. tariffs?
Yeah, we retain a core holding in India and an overweight on Korean equities. And we believe near-term pressure in these markets are actually opportunities to increase exposure. For India, the recent tension has introduced risk, including the unexpected 25% tariff on selected goods and an extra 25% levy tied with the Russian oil imports from India. But we view any potential restriction on India's services sectors or exports as possibly a bigger pressure point, given that services exports to the US are significantly larger than goods and merchandise exports. But that being said, we think the macroeconomic impact is likely to be pretty contained, as the Indian merchandise exports to the US only represent about 2% of the Indian GDP. And within Indian equities, we maintain a preference for domestic cyclicals, which stand to benefit from the resilience fundamentals and also sustained domestic flows. And for Korea, I think the proposed tax reform is waiting on market sentiment, although the situation remains fairly fluid, as the proposal is likely to be subject to revision. While the tax reform seems disruptive at a first glance, the proposal is actually showing alignment with the ongoing capital market reform efforts in Korea. We also note that some ranking members in the ruling Democratic Party have signaled a possible rollback of the capital gain tax proposal. So we believe the lower tariff rate for Korea, which is at 15% instead of the 25 earlier agreed with the US, and exemption for tech giants from the proposed 100% semiconductor tariffs are really the good factors to support the market in Korea.
All right, thanks, Ray. There's quite a lot of discussion around equity markets, but before we end today's podcast, maybe let's have a quick chat about gold and pound sterling. Any views of note that you'd want to share there?
Sure thing, Manpreet. Let maybe start with the sterling. Versus the dollar, we are actually having a range-bound view with a bearish bias on this sterling US dollar pair, as the BOE remain divided, with some favor more easing to support the slowing job market, while the others are worried about inflation. For euro sterling, we expect the Bank of England to cut rates more than the ECB over the next 12 months. While we do expect the pair to be range bound at about 0.861 to 0.06 to 0.888, we are having more of a bullish bias in the euro on this pair. We do also expect gold to be range bound in near term with a bullish bias, and we expect it to be trading around the US dollar 3,400 per ounce. We would also be advocating adding on dips for gold, and we think that the next catalyst for gold to take another leg higher would be the US economic witnesses. The recent witness in job report, as we earlier mentioned, if sustained in August, could push gold into our 6 to 12 month targets of US dollar 3,500 per ounce in our view.
All right. Well, thanks very much, Ray. I think that's bring us to the end of the time available for today's conversation. But thanks so much for joining us and speaking to our listeners. If I can sort of summarize the top takeaways from today's conversation, I think number one is that we do see some near-term headwinds for equities broadly, but we do think a lot of that, together with recent data, will drive a Fed rate cut in September. Second is that we'd be happy to be buying any dips in the S&P towards 5,800 to 6,000, and also to Indian and Korean equities on pullbacks, and Asian equities broadly, I suppose. And third is, of course, gold, another potential opportunity to add if we do get a dip. So we'll bring the conversation to close on that note today. Thanks very much for listening in. We hope you enjoyed the conversation, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.